Preferred's Weekly Review, New Preferred from Strategy. Pause. This article was written by ADS Analytics. Pause. Summary. We take a look at the action in preferreds and baby bonds through the third week of June and highlight some of the key themes we are watching. Preferreds delivered solid performance in April, with credit spreads tightening but yields rising due to higher treasury rates. Strategy, formerly MicroStrategy, issued a 10% non-cumulative preferred. Main risks are BTC price volatility and asset coverage mechanics, not cash flow. Michael Saylor may issue more preferreds or buy back common shares. Both actions could reduce asset coverage and increase risk for preferred holders. We are ADS Analytics, a team of former researchers and trading at several global investment banks. We run the investing group Systematic Income, where we scour all market sectors in our search for attractive high-yield opportunities. Welcome to another installment of our Preferreds Market Weekly Review, where we discuss preferred stock and baby bond market activity from both the bottom up, highlighting individual news and events, as well as top down, providing an overview of the broader market. We also try to add some historical context as well as relevant themes that look to be driving markets or that investors ought to be mindful of. This update covers the period through the third week of June. Be sure to check out our other weekly updates covering the Business Development Company, BDC, as well as the Closed-End Fund, CEF. Markets for perspectives across the broader income space market action. Preferreds delivered a solid result over the week and month to date. Credit spreads have continued to retrace their widening of early April, supporting prices. Despite this, however, overall yields have continued to rise due to the upward move in Treasury yields. Market themes. Strategy. The Bitcoin Treasury Company, previously known as MicroStrategy, issued a new preferred, STRD, offering $250 million worth of shares at $100 each. The dividend is 10%, non-cumulative. In terms of risks, this is an interesting case to think about, not just in this particular case, but more broadly as well. One common question is, where does Strategy get the cash to pay the preferreds? Strategy gets the cash for preferreds dividends, just like a mortgage REIT or a CEF gets the cash to pay preferreds dividends. It either gets them from its cash holdings or its assets, which are predominantly financial, i.e., BTC. This may be difficult for traditional widget makers whose main assets are plant, equipment, and inventory, which can be difficult to monetize quickly, but less so for Strategy, which is in effect a portfolio of financial, if unusual, assets. It can also fund dividends with earnings through its pre-BTC software business. Outside of this, Strategy has raised debt and has issued common shares in the market to raise more capital. The latter has been done at a premium to its book value. However, the premium is not a precondition to more share issuance. In short, there are multiple ways the company can fund the preferred's dividends. How it funds these dividends is not a top risk for preferred's shareholders. The main risk to preferred's holders outside the collapse in the price of BTC are indirect mechanics of lower asset coverage for the preferreds. For now, the common shares have been trading at a large premium to its BTC portfolio. So the company has been happy to sell more shares and use that to buy more BTC, generating additional value per share. Over time, this will likely compress its premium, particularly as other BTC treasury companies get going. Michael Saylor, the former CEO and current chairman, said that if the premium shrinks, he will be issuing more preferreds and use that to buy BTC rather than using new common shares to buy BTC. That will obviously decrease the asset coverage, likely pushing up the yields of the preferreds as well. The other thing he said is that at some point, if he thinks the common shares are too cheap, he will buy them back. That can make sense. This is a similar way that CEFs work when shares are cheap to the NAV. If you buy back a share for less than its NAV, you generate excess value for everyone else. The company probably wouldn't be jumping at the chance to do this, as it will shrink its BTC stash, but it's possible. More likely, however, MSTR will just keep issuing more preferreds, something that BDC PSEC has been doing, as it trades well below the NAV, so its ability to issue new common shares is constrained. Both of these actions would also reduce preferred asset coverage, likely raising their yields. Overall, the risk to the preferreds isn't really the underlying fundamentals, which are the usual risks, but things that have to do with market functioning, path dependencies, and the status of BTC in the financial system, which is what makes it tricky to think about the risk of the preferreds. There's little intuition or market history investors can apply in this case to properly evaluate the preferreds. Strategy has 3 preferreds: STRD, STRF, STRK, with STRK being convertible, holders' option to 1.1 of MSTR shares or $36.9 at today's prices versus current STRK price of $104, and STRK being cumulative. Investors are valuing the convertibility of STRK as more valuable than the cumulative aspect of STRF. STRK will be mostly driven by what's happening to BTC. Its payoff is roughly a collar, i.e. a call to the upside. The preferreds will trade as BTC to the upside and a put to the downside, i.e. if BTC goes to zero, so does STRK. There was a recent kerfuffle between Jim Chanos and Michael Saylor about what happens to the convertible bonds if they don't convert to equity. Saylor seemed to suggest that the bonds are not recourse to strategy and can be paid off with stock. Perhaps he meant that the bonds can be paid off with newly raised capital. However, even in this case, they would still be recourse to the company. Otherwise, they would not be bonds. The redemption of the bonds would also weigh on the asset coverage of the preferreds, as it would reduce the company's assets, unless the bonds are refinanced. The key takeaway here is that a drop in the BTC price will accelerate the drop in asset coverage, above and beyond the impact of BTC itself. At current levels, asset coverage is very high, so this is not a critical issue. However, these dynamics are worth keeping in mind for preferreds holders. Market commentary. Quite a few preferreds redemptions are coming up. Series I, PRIF, PRI. From the CLO Priority Income Fund, Wintrust Financial is redeeming WTFCM and WTFCP. UMB Financial is redeeming UMBFP. The CLO Equity Unlisted CEF PRIF has been on a roll with preferreds redemptions, having redeemed PRIF PRI, PRIF PRH, PRIF PRF, now PRIF PRI. As before, the stock redeemed was the nearest maturity one, rather than the highest coupon one, as is usually the case. If this continues, PRIF PRJ would be next. It's trading below $24, so is a good tactical hold here, given the trend of redemptions. PRIF PRI jumped 6% on the news. It is in the high-income portfolio and will be rotated out. The redemptions have pulled up the remaining PRIF preferreds, so their yields have fallen. It's not clear what's happening to the asset coverage of the preferreds, as the company does not report its portfolio figures frequently. The net assets of the company have fallen sharply by around 30%, so that is likely driving the redemptions, in order to keep leverage from rising. The NAVs of other CLO equity CEFs have also fallen this year, though not nearly by that much. We have held PRIF preferreds for several years. However, the redemption of PRIF.PRI will complete our exit from the suite. We remain partial to baby bonds from fellow CLO CEF fund Oxford Lane Capital Corp., OXLC, such as OXLCG and OXLCI, trading at yields of 8.4% and 8.2% respectively. This article was written by ADS Analytics. Pause.